Right now, as I'm recording this, there's a massive mistake happening in the gold market that's costing investors thousands of dollars. And the worst part? Most people have no idea they're making it. I've been tracking precious metals for over 2 decades, and I've never seen anything quite like what's unfolding right now. We're witnessing one of the most dangerous periods in gold investing history, not because gold is risky, but because of how people are buying it. Let me paint you a picture of what happened to Sarah, a 58-year-old teacher from Phoenix. 3 months ago, she decided to protect her retirement savings by buying gold. Smart move, right? She'd been watching the dollar weaken, inflation eating away at her purchasing power, and she knew she needed to act. But here's where it gets interesting. Sarah made the same mistake that 73% of new gold buyers are making right now. She bought gold ETFs, paper gold. She thought she was protecting herself, but she was actually exposing herself to a risk that could wipe out her entire investment overnight. See, Sarah didn't understand the difference between owning gold and owning a promise to deliver gold. And that difference is about to become crystal clear to millions of investors in the coming months. The mistake I'm talking about isn't just about ETFs versus physical gold. It's deeper than that. It's about understanding what's really happening in the gold market right now, and why the traditional ways of buying gold are becoming increasingly dangerous. Let me show you what I mean. Right now, there are approximately 100 ounces of paper gold being traded for every single ounce of physical gold that actually exists. Think about that for a moment. 100 paper claims on every real ounce. It's like having 100 people holding tickets to the same airplane seat. This isn't some conspiracy theory. This is documented fact. The COMEX, where most gold futures are traded, has a registered inventory of about 400,000 ounces of deliverable gold. But the open interest, the number of contracts that could demand delivery, represents over 40 million ounces. That's a 100-to-1 ratio. Now, you might be thinking, so what? Most people don't take delivery anyway. And you'd be right. Under normal circumstances, this system works fine. People trade paper, make their profits or losses, and move on. But we're not in normal circumstances. Something fundamental has shifted in the gold market over the past 18 months. Central banks, the smart money, the institutions that understand money better than anyone else, they're not buying paper gold. They're buying physical gold. Lots of it. In 2023, central banks purchased over 1,000 tons of gold. That's the highest level in 55 years. But here's the kicker. They're not buying it through the traditional Western markets. They're going direct to miners, making bilateral deals, cutting out the COMEX entirely. China alone has been adding between 15 and 20 tons of gold to their reserves every single month. Russia, despite sanctions, has been accumulating gold at record pace. India, Turkey, Singapore, they're all loading up on physical gold while retail investors are buying paper promises. This creates what I call the Great Divergence. While institutions accumulate real gold, retail investors are piling into paper gold, thinking they're getting the same protection. They're not. Here's where Sarah's story gets really interesting. 3 weeks ago, she tried to convert her gold ETF shares into physical gold. She called her broker, expecting a simple transaction. What she discovered shocked her. Her broker explained that her ETF shares couldn't be converted to physical gold. She owned shares in a fund that owned gold, but she had no direct claim to any specific gold bars. If she wanted physical gold, she'd have to sell her ETF shares and buy physical gold separately, paying taxes on any gains and starting over. But that's not even the worst part. When Sarah looked into buying physical gold, she discovered something that made her stomach drop. The premium, the amount above the spot price that dealers charge for physical gold, had skyrocketed. 6 months ago, you could buy a 1-ounce American Eagle for about $50 over spot price. When Sarah checked, that same coin was selling for $150 over spot. The premium had tripled. Why? Because there's a shortage of physical gold available to retail investors. This is the mistake that's costing people thousands. They're buying paper gold at paper prices, thinking they can convert to physical gold at any time. But when they try to make that conversion, they discover that physical gold is trading at a massive premium to paper gold. It's like buying a concert ticket online, only to discover when you show up that your ticket is actually just a receipt. And if you want to actually see the concert, you need to buy a real ticket from a scalper at 3 times the price. The divergence between paper and physical gold prices is accelerating. In London, The premium for physical gold over paper gold has reached levels not seen since the 2008 financial crisis. Coin dealers across America are reporting wait times of 4 to 6 weeks for popular gold coins, compared to next-day delivery just a year ago. This shortage isn't accidental. It's the result of a fundamental shift in global monetary policy that most investors don't understand. For the past 50 years, since Nixon closed the gold window in 1971, the global monetary system has been based on the dollar. Countries held dollars as reserves, traded in dollars, and trusted the dollar as the world's reserve currency. But that system is breaking down. Not quickly, not dramatically, but steadily and inevitably. The BRICS nations, Brazil, Russia, India, China, and South Africa, plus their growing list of partners, are building an alternative monetary system. They're settling trade in their own currencies, reducing their dollar reserves, and accumulating gold as a neutral reserve asset. This isn't anti-American sentiment. This is simple mathematics. The U.S. national debt has grown from $1 trillion in 1980 to over $33 trillion today. The dollar's purchasing power has declined by over 85% since 1971. Countries are simply diversifying away from an asset that's being systematically devalued. And their preferred alternative? Gold. Real, physical gold that they can hold in their own vaults, free from the risk of sanctions or political pressure. This creates what economists call a flow problem. Gold is flowing from west to east, from paper markets to physical markets, from retail investors to central banks. And once that gold moves east, it's not coming back. China hasn't sold a single ounce of gold from their reserves in over 15 years. Russia, despite needing foreign currency to fund their economy, hasn't sold their gold reserves. These countries are treating gold as a strategic asset, not a trading commodity. Meanwhile, Western investors are trading paper gold back and forth, creating the illusion of a liquid, efficient market, while the underlying physical gold disappears into strong hands that have no intention of selling. This is creating a powder keg in the gold market. At some point, the paper market and the physical market will have to reconcile. When that happens, the price adjustment will be swift and dramatic. We've seen this movie before. In 1980, the Hunt brothers tried to corner the silver market. As physical silver became scarce, the premium over paper silver exploded. When the paper market finally broke, silver prices shot from $11 to $50 in just a few months. But the current situation in gold is different. It's not speculators trying to corner the market. It's central banks, sovereign wealth funds, and institutional investors making strategic, long-term allocations to physical gold. The mistake that retail investors are making is thinking they can wait. They believe they can hold paper gold now and convert to physical gold later if needed. But later might be too late. Let me tell you about Marcus, a 45-year-old engineer from Dallas. Marcus understood the gold story early. He'd been buying gold ETFs for 3 years, accumulating a position worth about $180,000. Smart guy, right? Last month, Marcus decided he wanted to hold physical gold instead of paper gold. He figured it would be a simple switch. Sell the ETFs, buy the coins, done. But when Marcus went to make the switch, he discovered that his $180,000 in ETF shares could only buy about $140,000 worth of physical gold after premiums, taxes, and transaction costs. He lost $40,000 just making the switch from paper to physical. Marcus made the classic mistake. He assumed that gold is gold, whether it's paper or physical. But in today's market, that's simply not true. Paper gold and physical gold are becoming two different assets with two different prices. The smart money figured this out years ago. That's why central banks don't buy gold ETFs. That's why billionaires like Ray Dalio and Paul Tudor Jones hold physical gold, not paper gold. They understand that in a crisis, paper promises become worthless, but physical assets retain their value. Now, I know what some of you are thinking, but paper gold is so much more convenient. I can buy and sell instantly. I don't have to worry about storage or insurance. And you're right. Paper gold is more convenient. But convenience comes with a cost. And that cost is becoming higher every day. Here's what most people don't understand about gold ETFs. When you buy shares in a gold ETF, you're not buying gold. You're buying shares in a trust that owns gold. You have no direct claim to any specific gold bars. You can't walk into the vault and point to your gold. More importantly, the ETF can change its rules at any time. During the 2008 financial crisis, several commodity ETFs suspended redemptions, trapping investors in positions they couldn't exit. The fine print in most gold ETFs gives the fund managers broad discretion to limit or suspend redemptions during extraordinary circumstances. Guess what qualifies as extraordinary circumstances? A run on physical gold, a breakdown in the paper gold market. Exactly the scenarios where you'd most want to convert your paper gold to physical gold. It's like having flood insurance that gets canceled when it starts raining. But the convenience factor is about to become irrelevant anyway. As the premium between paper and physical gold continues to widen, the paper gold market is becoming increasingly unstable. Think about it logically. If you can buy paper gold for $2,000 an ounce, but physical gold costs $2,200 an ounce, what happens when people start demanding delivery? The ETF has to go into the market and buy physical gold at $2,200 to deliver against shares that were sold at $2,000. That's a $200 loss on every ounce. How long can that math work? It can't, and it won't. We're already seeing cracks in the system. Several smaller gold ETFs have had to suspend redemptions in recent months due to operational difficulties. Translation: they can't source enough physical gold to meet redemption demands. The big ETFs like GLD and IAU haven't had problems yet because they're so large. But size can become a liability when everyone heads for the exits at the same time. And here's the thing that really keeps me up at night. Most investors have no idea this is happening. They're sitting on paper gold positions, thinking they're protected against inflation and currency debasement, while the very system they're relying on is breaking down around them. The financial media isn't talking about this. Your broker isn't warning you about this. Why? Because they make money on trading volume, and paper gold generates a lot more trading volume than physical gold. But the signs are everywhere if you know where to look. Coin dealers are rationing sales. Premiums are spiking. Delivery times are extending. The smart money is quietly moving from paper to physical, while retail investors remain oblivious. Speaking of protecting your wealth, if you're sitting on $100,000 or more in retirement accounts, you might want to check out the free guide I put together on gold IRAs. It's in the description below. Shows you exactly how to get physical gold into your retirement account without tax penalties. Could be worth looking at if you're concerned about the direction things are heading. Anyway, back to the main point. The mistake that's costing investors thousands isn't just about paper versus physical. It's about timing. The longer you wait to make the switch from paper to physical, the more expensive that switch becomes. 6 months ago, the premium was $50 per ounce. Today it's $150 per ounce. Where will it be 6 months from now? I've been studying precious metals markets for over 20 years, and I've never seen premiums rise this quickly, or this consistently. Usually, premiums spike during crises and then fall back to normal levels. But this time is different. This time, the premium increase isn't driven by panic buying. It's driven by structural changes in the global monetary system. Central banks aren't panic buying gold. They're making strategic, long-term allocations. And once they buy gold, they don't sell it. This creates a one-way flow of gold from the retail market to the institutional market. Every ounce that moves from weak hands to strong hands is an ounce that's permanently removed from the available supply. The math is simple but brutal. Global gold production is about 3,000 tons per year. Central bank purchases alone are running at over 1,000 tons per year. Add in institutional buying, jewelry demand, and industrial use, and you quickly realize that there's not much gold left for retail investors. And yet, retail investors keep buying paper gold, thinking they're getting the same exposure as the central banks and institutions buying physical gold. They're not. Here's another story that illustrates the problem. Jennifer, a 52-year-old accountant from Seattle, had been dollar-cost averaging into a gold ETF for 5 years. She'd accumulated about $250,000 in gold ETF shares, buying a little bit every month regardless of price. Jennifer thought she was being smart. She was diversifying away from stocks and bonds, protecting herself against inflation, building a hedge against economic uncertainty. And on paper, her strategy was working. Her gold position had gained about 40% over 5 years. But last month, Jennifer's financial advisor called with some disturbing news. The ETF that Jennifer had been buying was having liquidity issues. The fund was struggling to source enough physical gold to back all the shares that had been issued. The fund's solution? They were going to start backing some of their shares with gold futures contracts instead of physical gold. Essentially, they were turning a physical gold ETF into a paper gold ETF. Jennifer had a choice. She could stay in the fund and accept that her gold investment was now partially backed by paper promises, or she could redeem her shares and buy physical gold. Jennifer chose to redeem. But when she calculated the cost of converting her $250,000 in ETF shares to physical gold, she was shocked. After premiums, taxes, and transaction costs, her $250,000 would buy about $190,000 worth of physical gold. She lost $60,000 just making the switch from paper to physical. That's a 24% haircut for doing what she thought she could do at any time without cost. Jennifer's story is becoming increasingly common. Investors who thought they owned gold are discovering they own promises to deliver gold. And those promises are becoming increasingly expensive to fulfill. The really scary part is that Jennifer was one of the lucky ones. She was able to make the switch, even at a significant cost. But what happens when the paper gold market becomes so unstable that redemptions are suspended entirely? It's not a hypothetical question. During the 2008 financial crisis, several commodity funds suspended redemptions. Investors were trapped in positions they couldn't exit, watching their investments decline while being unable to do anything about it. The same thing could happen to gold ETFs if the divergence between paper and physical gold continues to widen. At some point, the math simply doesn't work anymore. But here's what's really insidious about this situation. The paper gold market is actually suppressing the price of physical gold. All that trading volume in gold ETFs and futures contracts creates the appearance of abundant gold supply, keeping prices artificially low. Meanwhile, the physical gold market is experiencing severe shortages, driving premiums higher and higher. So you have the bizarre situation where the price of gold, as reported in the financial media, is going down or staying flat, while the actual cost of buying real gold is going up dramatically. It's like having two different markets for the same asset, with two different prices. And most investors don't even realize they're in the wrong market. This disconnect can't last forever. At some point, the paper market and the physical market will have to reconcile. When that happens, one of two things will occur. Either the paper gold price will spike up to match the physical gold price, or the paper gold market will collapse, as investors realize they can't convert their paper holdings to physical gold at anywhere near the stated price. My money is on the second scenario. Here's why. The paper gold market depends on the assumption that most investors will never demand physical delivery. It's a fractional reserve system, just like banking. As long as only a small percentage of investors want to convert their paper gold to physical gold, the system works fine. But what happens when that percentage increases? What happens when 10% of gold ETF investors decide they want physical gold instead of paper gold? Or 20%? Or 30%? The system breaks down. There simply isn't enough physical gold to back all the paper claims. And once investors realize this, the rush for the exits becomes a stampede. We're already seeing the early stages of this process. Premiums are rising, delivery times are extending, and smaller ETFs are having operational difficulties. These are warning signs that the system is under stress. The smart move is to get ahead of this trend, not wait for it to play out. Because once the breakdown becomes obvious to everyone, it will be too late to make the switch from paper to physical at a reasonable cost. But there's another dimension to this story that makes it even more urgent: the geopolitical dimension. Right now, most of the world's gold trading happens through London and New York. The London Bullion Market Association and the COMEX in New York are the primary price discovery mechanisms for gold globally. But that's changing. China has been building their own gold trading infrastructure. The Shanghai Gold Exchange is becoming increasingly important in global gold price discovery. Russia has been developing bilateral gold trading relationships that bypass Western markets entirely. This isn't just about trade. It's about monetary sovereignty. Countries that hold their gold reserves in London or New York are subject to the political decisions of those jurisdictions. We've seen this play out with Russian assets being frozen due to sanctions. Other countries are taking note. They're repatriating their gold reserves, moving them from Western vaults to domestic vaults. Germany famously repatriated 674 tons of gold from New York and Paris between 2013 and 2017. Other countries are following suit. This creates another source of demand for physical gold that doesn't show up in traditional market analysis. Countries aren't just buying gold, they're also moving existing gold from Western vaults to domestic vaults. That's gold leaving the Western market system permanently. And here's the kicker. Most of the gold held in Western vaults is already spoken for. The gold in the Bank of England's vaults belongs to various central banks and institutions. The gold in COMEX vaults is backing futures contracts and ETF shares. There's very little unencumbered gold available for purchase by retail investors. Most of what's available comes from recycling, mining production, and the occasional institutional sale. But mining production is declining. The easy gold has already been mined. New gold discoveries are rare and expensive to develop. Recycling provides some supply, but not nearly enough to meet growing demand. This supply-demand imbalance is what's driving the premium explosion in physical gold, and it's only going to get worse. The mistake that investors are making is thinking they can wait. They believe they can hold paper gold now and convert to physical gold later when they really need it. But later might be too late. The time to make the switch from paper to physical is now, while it's still possible, even if it's expensive. Because the alternative, being trapped in a paper gold position that can't be converted to physical gold at any reasonable price, is much worse. Let me give you a historical parallel that might help illustrate the point. In the 1960s, the US was running a gold standard where foreign governments could exchange dollars for gold at $35 per ounce. But the US was printing more dollars than it had gold to back them. Foreign governments started to notice this and began demanding gold instead of holding dollars. France famously sent a warship to New York to collect their gold. As the demand for gold conversion increased, the US faced a choice: either dramatically reduce the money supply to match their gold reserves or abandon the gold standard entirely. They chose to abandon the gold standard. On August 15, 1971, President Nixon temporarily suspended the convertibility of dollars to gold. That temporary suspension is still in effect today, over 50 years later. The investors who held dollars thinking they could convert them to gold at $35 per ounce were out of luck. Overnight, that conversion became impossible. The same thing could happen to paper gold. If the demand for physical conversion exceeds the available supply, the paper gold system could simply suspend conversions. Investors would be left holding paper promises that can't be fulfilled. The signs are already there: rising premiums, extended delivery times, operational difficulties at smaller funds. These are the early warning signs of a system under stress. The question is, will you heed these warning signs, or will you wait until it's too late? I've been in this business long enough to know that most people will wait. They'll convince themselves that this time is different, that the system will hold together, that they can always convert their paper gold to physical gold later. But the smart money isn't waiting. Central banks aren't waiting. Institutional investors aren't waiting. They're moving from paper to physical now, while it's still possible. The mistake that's costing investors thousands is the belief that paper gold and physical gold are the same thing. They're not. They're becoming two different assets with two different risk profiles and two different prices. Paper gold offers convenience and liquidity, but it comes with counterparty risk and conversion risk. Physical gold offers security and independence, but it comes with storage costs and less liquidity. In normal times, that trade-off might make sense. But these aren't normal times. We're living through the biggest monetary experiment in human history. Central banks are printing money at unprecedented rates. Governments are running deficits that would have been unimaginable just a few decades ago. In this environment, the convenience of paper gold isn't worth the risk. The risk that your paper gold can't be converted to physical gold when you need it most. The risk that your gold ETF suspends redemptions during a crisis. The risk that your paper gold becomes worthless while physical gold soars. The investors who understand this are making the switch now, despite the cost. They're paying the premium, accepting the inconvenience, and taking possession of physical gold while it's still possible. The investors who don't understand this will learn the hard way. They'll discover too late that their paper gold was just that, paper. And by the time they try to convert to physical gold, the cost will be prohibitive, or the conversion will be impossible. The choice is yours. You can continue to hold paper gold and hope that the system holds together. Or you can pay the premium now and secure your position in physical gold while you still can. But don't say you weren't warned. The signs are everywhere. The smart money is moving. The question is, will you move with them? Or will you be left holding worthless paper when the music stops? The gold market is changing in ways that most investors don't understand. The old rules don't apply anymore. The assumption that paper gold and physical gold are interchangeable is becoming dangerously obsolete. The investors who adapt to this new reality will protect and grow their wealth. The investors who don't will learn an expensive lesson about the difference between owning an asset and owning a promise to deliver an asset. The time to act is now. Not tomorrow, not next week, not when the crisis becomes obvious to everyone. By then, it will be too late. The premium will be too high, the supply will be too scarce, or the conversion will be impossible. Don't make the mistake that thousands of investors are making right now. Don't assume that your paper gold will protect you when you need it most. Make the switch to physical gold now, while you still can, and secure your financial future before it's too late.